Hi friends, I'm back. I must first apologize for the past 2 weeks when Etienne's place has been out of circulation, so to speak. It has been a relatively hectic tax season, as you all will understand, and during this time over the past 2 weeks, we were really unable to get out, what you're accustomed to, your regular tidbits on a weekly basis. So we're back. Again, I'm David Etienne of Etienne Business Solutions. We present to you Etienne's Place. Now, today I just want to continue on the theme of tax, tax implications, tax considerations. Now, usually when we come to the end of our working life, one of the things that comes to mind is hip hip hooray, I'm now through with tax payments. I'm now through with having to, as it were, dish out my hard earned income in tax payments to whether it be the federal, the state, or local authorities. But though I don't want to be the bearer of bad news, I just still need to bring you up to speed so that you're cautious and not be prematurely jubilant about retirement and being able to avoid the tax implications of income earnings. When one retires, normally the two main sources of financial support would be yes, your retirement funds, your 401k, whatever it is. So you're now retired and say it's now time for me to, receive my pension. In addition to that, you have your social security benefits. So that's your pension, your social security benefits. But in addition to that, because a number of persons would have retired but are still able to be gainfully employed, or they are still in good health and therefore, choose not to just sit around the home, but to seek to do something that is not as hectic as the main job, but then something that keep them occupied and brings some sort of income. So in that case, we would have your retirement income, your pension, you have your social security benefits, and then you would have those, smaller income streams. Let's look at each in turn. In most instances, where you have your employer sponsored retirement plan, the common one being your 401k, etc., then invariably the money that is put in such a fund is your money, yes, that is matched to an extent by your employer, maybe up to 3% or so. But bear in mind that when that money was taken from your salary and put into your retirement account, it was taken from your salary before your salary was taxed. And so we talk about your 401k, your retirement account, being funded with pre-tax money. Pre-tax money. So you have not yet paid any taxes on those funds. They are taken straight out of your salary and put into your retirement account. By virtue of that fact, it means, therefore, that at retirement, when you're now receiving these distributions of retirement benefits through your pension fund, then of course you would expect that it is now time to address the tax implication. And so when pensioners are getting their regular distributions month over month, then some are taken aback to see that, oh wow, I still have to be paying taxes on these distributions. Yes, because when the monies were put into the fund, it was put there pre-taxed for your benefit so that you have a greater amount to go into the plan and to grow. But then at distribution, as I said before, it now becomes taxable. The second is your Social Security benefits. Yes, and as a general rule, Social Security benefits are non-taxable benefits. They are not taxable as a general principle. Not taxable. Okay? Good. We come to the third one, which I indicated for individuals who still feel, able and do not want to stay at home, will go out and seek some form of employment or even engage in some self-employment activity that brings some income. And therefore, there's this third stream of income flowing to this person. Naturally, or in most instances, this person will be engaged in an activity in some sort of employment that usually under the heading of sort of like a contractual basis. And so the payments received for those activities usually are not taxed by the, so to speak, employer. And so they are reported on a 1099, and this person would need, therefore, to report them. Good. So we have these three inflow of funds coming to a retired person. So this person comes to prepare his or her taxes, has your distribution for pension, distribute Social Security benefits, and then you have some other income. And when all of that is put together on your tax returns, it reports a total income of X dollars. Here comes the tax implications. One, we mentioned that the pensions money was not taxed before, and so it is now taxable income. And most of us accept that. Secondly, Social Security is not taxable. Now remember, you receive your Social Security, once you qualify for it, you're out of the work arena, and therefore you join your Social Security. However, if you're fortunate enough to have some sort of employment, post-retirement employment that brings some income, then you have to be mindful that there may be some tax implication arising that will impact your Social Security benefits. Now, as a general rule, there's a formula. There's a formula that we'll not get into that. There's a formula. But as a general rule, for individuals who are filing under the status of married filing joint, then usually 34,000 or less. I think it's 32,000 or less. And for others like persons filing as single head of household, then 25,000. At that range of other income earned, then your Social Security will continue to be untaxed. Married filing joint, earning 34,000 or less from some other sources while receiving Social Security and maybe your pension. And then single persons, head of household, who are getting $25,000 will go away with your full Social Security benefits untaxed. Now, if you're receiving between $32,000 and $44,000 and your filing status is married filing joint, or if you're receiving between $25,000 and $34,000 and your filing status is single or head of household, then you will find that 50% of your Social Security now becomes taxable. So if you look at your tax returns, you will see that section where that reflects your total Social Security received, and then you will see that 50% of that figure is extended to that column on your 1040 where your taxable benefits or incomes are reflected. So bear in mind, once you go in the $32,000 to $44,000 other income and you're married filing joint, or you're in the 25,000 to 44 to 34,000 bracket under the heading of single or head of household, then 50% of your social security benefits now becomes taxable. So we have the tax on the retirement account, the 401k, whatever it is. Then now we're hit with 50% of your social security benefits being taxable. And of course, the other income earned, this 34,000 or 44, 32,000, that has caused your social security benefits to be 50% taxable, that income now has to also give up its share of taxes on that earning, because that would have either been, been taxed by the person who employ you, or in most instances, as I indicated earlier, you would get these funds without any tax being taken out, and they will be reported to you on a 1099 form, and therefore, come tax time, you will have to know deal with the tax implication there. So right away, as I started, so you're retired, and in your mind, the days of taxes and taxes and taxes is over. I'm now outside of that work cycle that brings about tax headaches. Not true. Not true. Pension was not taxed, will now be taxed on distributions. Social security benefits normally not taxable. However, if you have other income, and I mentioned the ranges, some of your social security benefits will become taxable. We go further on the social security benefits. If under the status of married filing joint, you now end up in the greater 44,000 or more, $44,000 or more of income, and if you fall in the single head of household, etc., and you have income of greater than 34,000, remember I say income, earned income, then it means therefore that your social security benefits now becomes 85% taxable. Put another way, 85% of your social security benefits now becomes taxable income. Yes, taxable income. The comforting thought is that 85% of your social security is the most that can be taxed, that will be taxed. So in other words, social security benefits will be taxed to up to 85% of what is paid to you. Okay, so even if you start to earn 100,000, etc., you'll find maybe other things will chip in, but your social security benefits can only be taxable up to that maximum point of 85% of the benefits. So at one band, no tax on your social security. As you earn up to the 32,000, 44,000, as I mentioned before, then you go into your 50% of your social security benefits are taxed. And once you exceed that by going in excess of 44,000 as married filing joint, or a single head of household, then 85% of your social security benefits now become taxable. So you're retired, but the scourge of taxes follows you into retirement. It is important, though, to know that with your social security distributions, benefits, with your pension benefits, and even with your other little job, it is likely that you may not have a total earnings that is as great as when you were fully gainfully employed, when you were just getting a full salary from your job and all the other benefits. Okay, so although you're getting pension distributions, social security distribution, have another little job, the total of those may not necessarily be as great as when you were fully employed. What does that mean? It means, therefore, that the lower total benefit to you, total income, so to speak, will automatically put you in a lower tax bracket compared to when you were fully employed in your job that you have held for 10, 15, 20 years. So although all these things become taxable, they are now to be taxed at a much lower tax rate than would have been had they been taxed back then. So for example, all the distribution, all the contributions that were taken from your salary and put into your retirement account, maybe at that time you could have been in the 15, 20, 25% tax bracket at that time because your overall income was pretty high. But those monies that went into the 401k was put there pre-tax. Now that you're getting a distribution through retirement, you're getting these monies and they now become taxable. But you may, by virtue of lower overall income, sit in the 10 or 15% tax bracket. And so these distributions, though taxable, will be taxed at the lower rate of 10 or 15 compared to the possible 2025 when you were fully employed a couple of years back, maybe 5, 10, 15 years back. So that's a big benefit to note, very big benefit to note. Okay. That said, quite often when you're receiving your distributions, pensions distributions, oh, and I'll just quickly mention that some individuals may retire long before or somewhere before he or she becomes 59 and a half years old. Now, if you retire before you're 59 and a half years old and you choose to start taking your pension, retirement, distributions, then bear in mind that all distributions, all retirement distributions to you that is given before you are at least 59 and a half years old, there comes with it what we refer to as an early distribution penalty. The early distribution penalty is usually 10% of the distribution. So there's a tax on the distribution of the retirement monies. There's also the penalty for taking it too early, meaning that you're taking these distributions before you are, at least 15 and a half years of age. So you need to bear that in mind. Bear that in mind. Also, usually when your pension monies are distributed to you, quite often, if you're say less than at 15 and a half years old, the distributing company normally withhold about 20%. Because what they're doing, they're holding the 10% for early distribution penalty, and they're holding an additional 10% for federal taxes. Bear in mind, quite often that 10% tax that they're withholding may not necessarily satisfy the full tax implication of your distribution because you may really be in a 15, 16, 20% tax brackets, effective tax rate. So therefore, you have to bear in mind that although they have taken just 10% tax, it does not necessarily mean that you have fully satisfied your tax burden on that distribution. Now, of course, if they're taking 20% and you have already passed that 15 and a half years barrier or border, then it means that the full 20% is really taxes. Is really the tax against the distribution, and so chances are you'd have already satisfied your tax obligation because you would have been in 20%. So that's another thing to bear in mind. As a quick recap, as I indicated earlier on, there's a formula, and as usual, I always have to repeat it here at Etienne's Place. We're just trying to keep it very simple, give you the basic understanding as it were, prick your curiosity or your thoughts to look into things, and so, if necessary, to seek further advice. But in a nutshell, there is a formula that is used to calculate if and when some of your social security benefits will become taxable, and by what percent, whether it be the 50% or the 85%. Okay, there's a formula that takes the other income and the social security distribution and take a percentage of that, etc., etc. We're not going into that here and in this place, but I want you to be aware that there are tax implications that follow you, that follows you even after retirement. Okay. But as usual, we say debt, taxes, and a few other things that I think you will never get away from them. But they can be managed. You see, they can be managed. It just comes with some knowledge of what are the expectations. So, as I said before, we were away for 2 weeks, but we're back. Etienne's Place is back to help you to, as it were, navigate all the issues surrounding your finances, your personal financial planning, your taxation issues, your business accounting issues, etc., etc. And so we continue to bring these tidbits to you. We encourage you to subscribe, encourage you to share these presentations with your friends, family, co-workers, associates, and be empowered, be informed, and be successful. Thank you again for joining Etienne's Place, and I'll see you again in the coming week. Have a wonderful week and be your best at all that you do. I'll catch you.